Welcome back to One More Stock channel. We are kicking off a deep dive today into, well, one of the most intellectually puzzling market events of the quarter, the incredible paradox of AMD.
It really was a head-scratcher, wasn't it? You had a company delivering a massive financial beat, yet the stock actually dropped. We're going to unpack the analysis from the One More Money blog to understand this disconnect. Because, I mean, on paper, the Q3 numbers were truly astounding.
They really were. AMD reported record revenue, what was it, $9.2 billion. That's a huge 36% year-over-year growth. And their earnings per share hit $1.20, comfortably beating the consensus estimates. Yet, like you said, the stock fell about 3.7% after earnings. So the question for anyone following AMD is just why.
Exactly, and that's our central mission today, to understand why a monumental financial beat just wasn't considered good enough by the market. This intense volatility, it really reflects the core challenge facing AMD right now. The market is trying to value a company whose true multi-billion-dollar AI payoff is still maybe 18 to 36 months away. That price tag seems to reflect a perfect, almost flawless future, and, well, any hint of delay gets punished immediately.
Okay, let's start with the current strength then, because the foundation is solid. CEO Lisa Su was clear in characterizing the Q3 results. She mentioned broad-based demand, right, for EPYC, Ryzen, and the Instinct AI accelerators. So this wasn't a win built just on one single thing.
No, it was definitely synchronized strength. But what's fascinating here and kind of telling is that the market immediately looked past those historical numbers and focused entirely on the execution needed for the future. The One More Money blog highlighted 3 core reasons for that post-earnings skepticism.
Okay, let's get into those, starting with the big one, valuation premium.
Right. So AMD is currently priced essentially as an AI market leader. That's a position they haven't fully secured just yet. The stock's high multiple, it already prices in near flawless execution all the way through 2027, maybe even beyond. So investors aren't really celebrating the current win. They're already looking for guaranteed wins 2 years down the line. That valuation basically requires them to never stumble.
Wow, okay, so if the valuation demands perfection, what's the most critical dependency then? The thing that introduces the risk of imperfection.
Well, that brings us neatly to the second point, futures dependency. Investor focus immediately shifted to the unreleased MI450 accelerator. This product, it's still largely a conceptual futures product, right? But it's necessary to fulfill those enormous, highly publicized contracts, specifically thinking about the one with OpenAI and also the partnership with Oracle. So if that MI450 timeline slips even a little or its manufacturing yield isn't perfect out of the gate, the entire thesis of exponential growth gets jeopardized.
And if that wasn't enough execution risk on its own, we have geopolitical factors layering on this regulatory uncertainty.
Precisely. Yeah, that's the third reason for the market's skepticism, according to the blog. Management explicitly excluded any significant potential revenue from the MI308 China AI chip in their Q4 guidance. Now look, that's probably prudent and conservative given the regulatory uncertainty over there, but it creates an overhang. Investors see this massive potential upside. I mean, the China market is huge, but because management can't guide to it, the market treats that revenue as entirely risk-adjusted, or worse, just non-existent for now.
Okay. Let's try and ground this high-flying growth narrative back in the bedrock financial stability we actually saw in Q3. Total revenue was $9.246 billion. Impressive. But I was particularly struck by the sustained non-GAAP gross margin at 54%.
Yeah, that margin stability is absolutely structurally vital. You got to remember, to compete head-on with NVIDIA, AMD has to pour billions into R&D and advanced manufacturing tech. Usually that kind of spending compresses margins, right? But the fact that AMD maintained that 54% non-GAAP gross margin and generated a record $1.5 billion in free cash flow, well, that's kind of the secret sauce. This FCF proves the core EPYC and Ryzen businesses are powerful and highly profitable. Profitable enough to self-fund this aggressive AI arms race without needing, massive external financing.
That structural resilience really comes through when we break down where the revenue actually came from. It shows some good diversification.
Yeah, look at the numbers. The data center segment, which everyone agrees is the critical future growth vector, was up 22% year over year to $4.3 billion. That's the engine. But providing that massive profitability anchor, the combined client and gaming segments surged, get this, 73% year over year to $4.0 billion.
Wow, a 73% surge in client and gaming? That's huge. Does that create a new kind of risk, though? I mean, does AMD become too dependent on cyclical things like console sales when the whole bull case really rests on data center growth?
That's a great question, actually. It adds some important nuance. While the embedded segment was down 8% to $857 million, which was anticipated due to inventory correction, the sheer strength of data center and that cyclical peak in client gaming completely absorbed the weakness. The key thing is that the margin profile of EPYC and Ryzen is so strong that even if gaming softens cyclically, as it probably will, the cash generated still feeds that vital R&D pipeline for data center. They're essentially funding their future with today's profits.
I got it. Okay, now let's hone in on the data center, what you call the engine. It's the true foundation of the long-term bull case, driven by those EPYC CPUs and the Instinct AI accelerators.
Yeah, and what's fascinating here is the structural advantage of what industry analysts are calling the AI pull-through effect. Think of it like this. When cloud providers like Azure or AWS build their massive GPU infrastructure using AMD's Instinct chips, they also have to commensurately expand their EPYC CPU capacity. You need those EPYC processors for data orchestration, pre-processing control, all the stuff happening around the GPU cluster.
Ah, okay. So AMD doesn't just sell the specialized AI chip, the accelerator. They sell the furnace and the whole smart home system that coordinates it, basically. They capture revenue at multiple layers of the tech stack.
Precisely. They capture revenue from both the EPYC CPU layer and the Instinct GPU acceleration layer. This gives them a pretty profound synergistic advantage over companies that maybe only sell one side of that equation. This dual revenue stream makes their data center growth potentially more resilient and deeper.
And we are already seeing tangible commercial validation for the current Instinct AI accelerators, right? The MI350 series seems to be gaining real momentum.
Absolutely. I think the key commercial validation came from Oracle Cloud Infrastructure, OCI. They publicly announced cloud instances powered by the flagship MI350X. That kind of external proof of reliability and performance is essential. It moves the discussion past just internal benchmarks and into real-world enterprise deployment. People notice that.
But the software ecosystem, that remains the ultimate battleground, doesn't it? And this is where the skeptical market really focuses its attention. For listeners maybe less familiar, what exactly is the difference between ROCm and the established CADA, and why is that software gap seen as the primary barrier?
Yeah, that's the core friction point, absolutely. So CADA is NVIDIA's proprietary software platform. It's been entrenched for, 2 decades now. It functions as a complete, deeply integrated ecosystem, makes it relatively easy for millions of developers to write code for NVIDIA GPUs. ROCm, AMD's equivalent platform, is newer and, importantly, it's open source. Now, while it is rapidly maturing and ROCm 7.0 is a crucial milestone migrating from that established CADA ecosystem, it's still a heavy lift for the vast majority of developers out there.
So even if the MI350X hardware is physically as powerful, maybe even more powerful than an equivalent NVIDIA chip, developers still face complexity and time cost when they think about switching ecosystems. Is that it?
Exactly. ROCm 7.0 tries to address this head-on by focusing on usability and performance. It now offers optimized support for the MI350 series, and crucially, it includes day zero support for large-scale language models like Llama 3.370B. This open-source strategy is actually incredibly attractive to the large hyperscalers. Think OpenAI, Meta. They have the engineering teams to customize the platform, and frankly, they actively want to avoid vendor lock-in with NVIDIA.
Okay, and here's where those future execution risks really come into sharp focus. The partnerships. That OpenAI deployment started with the MI450 sounds truly monumental. Can you talk a bit about the projected scale?
Oh, it's massive. The deal involves a multi-year commitment for deploying up to 6 gigawatts, that's GW, of Instinct GPUs. It commences with the MI450 in the second half of 2026. This is expected to drive tens of billions of dollars in revenue. That kind of scale provides incredible revenue visibility, which, is the foundational pillar of the bull case.
Right, but doesn't that same huge scale introduce significant customer concentration risk? This is where that second source risk comes in, correct?
It absolutely does. Yeah, industry analysis suggests OpenAI is primarily seeking diversification. They want leverage against NVIDIA's pricing power and, frankly, NVIDIA's current supply bottlenecks. So if NVIDIA manages to resolve its supply issues, or if the competitive dynamics shift, the full scale of AMD's 6GW deployment could be subject to adjustment. Future revenue is tied not just to AMD's tech, but also to how fiercely NVIDIA defends its massive market share.
So to counter that logistical risk and maybe simplify deployment for these huge clients, AMD seems to be shifting its strategy, moving from just selling components to selling entire integrated systems. This is the Helios platform concept.
Yes, that system-level strategy is really key to succeeding in the enterprise space. AMD is delivering pre-integrated rack-scale solutions, the Helios platform, which bundles the MI450s, the upcoming Vesper Vesper CPUs and their Pensando networking chips. This dramatically simplifies the complexity of actually standing up a massive AI supercluster, and the validation is already there. OCI committed to deploying an AI supercluster based on Helios in Q3 2026. This kind of validates that the market accepts AMD's holistic, system-level approach.
And beyond the hyperscalers, they're also getting some significant traction in the high-stakes world of sovereign AI and mission-critical government environments.
Yes, those high-profile contracts with the U.S. Department of Energy are crucial validation points. You've got the Lux AI supercomputer, which will use MI355X GPUs and EPYC CPUs, and then the Future Discovery supercomputer, leveraging the next-gen Venice EPYC and MI430X. These wins confirm AMD's reliability and stability in the most demanding long-term environments. And that offers a predictable revenue foundation, which is always good.
Okay, so let's try to synthesize everything we've covered. If we had to boil down the core bull case for AMD right now, what would you say it is?
I'd say the bull case is defined by maybe three main factors. First, that clear MI450 revenue visibility, anchored by the huge OpenAI commitment. Second, continued market share capture in data center EPYC, which gets amplified by that high-margin AI pull-through effect we talked about. And finally, there's the secular tailwind of the emerging AI PC market, which some forecasts say could command like 55% market share by 2026. So the potential for explosive growth is definitely real.
Okay, now for the counterpoint.
Yeah.
The bear case. Why, despite all this undeniable momentum, did the stock actually decline after such a strong Q3 report?
Yeah.
What are the bears focused on?
Right. The bear case hinges almost entirely on execution and valuation. First, extreme valuation. Trading at a forward PE of, 65.15x. That's nearly double the semiconductor industry average of around 33.44x. That multiple just implies that any hiccup is completely unacceptable. Second, the execution risk. We keep coming back to this, but the MI450 is still a futures product. AMD has to flawlessly navigate these colossal logistical challenges, things like fabrication yields at the foundry, securing enough HBM high-bandwidth memory supply, advanced packaging techniques. Any delay here could be catastrophic to that valuation premium.
And finally, that software ecosystem challenge we discussed earlier.
Exactly. Third point for the bears is the software gap. Despite RSEM 7.0's rapid maturity and the clear support it's getting from hyperscalers, migrating from the decades-old CUD ecosystem remains a major friction point for the vast majority of application developers out there. Until RSEM achieves truly frictionless adoption across the board, that gap remains the primary drag on broader Instinct adoption outside of just the biggest players.
Okay, this brings us to the Q4 outlook, which maybe offers a small clue about management's near-term confidence. What do they actually guide for?
Yeah, the Q4 2025 revenue guidance midpoint is $9.6 billion. That represents a pretty robust 25% year-over-year growth. This is clearly being driven by that continued data center momentum.
But there's a factor that prevents that growth from being even higher, isn't there? Something tempering expectations a bit.
Correct. The tempering factor is the anticipated cyclical decline in the high-volume gaming segment. It's following that console peak we saw boost the Q3 numbers. Makes sense. However, and this is important, there's a potential upside surprise we have to remember. The Q4 guidance explicitly excludes any potential revenue from those MI308 China AI chip shipments. So if regulatory clarity emerges over there, that revenue would represent substantial, unguided upside potential for the quarter. Could be significant.
So wrapping this up, what does this all mean for us observing AMD? It seems like they've passed the initial product capability test. The technology is clearly competitive, and it's gaining real commercial traction.
Yeah, I think that's fair. The next 18 months or so will really test management's logistical and strategic prowess. They absolutely must convert that monumental potential, we're talking tens of billions of dollars in future revenue, into realized, repeatable profit. The volatility is likely going to remain until the MI450 hits mass deployment with perfect execution and high yields. The market is essentially just sitting there saying, show me the chips and the mature software ecosystem or else. It's a show me story now. As long-term investor, we view AMD as a potential candidate to accumulate more buy on dip. This is not an investment advice, just our own opinion.
Thank you so much for watching. We truly appreciate you taking this deep dive with us today. If you're interested in U.S. stock investment, please do subscribe to the OneMoreStock channel so you won't miss any of our latest videos in the future. And hey, please also like this video and leave a comment. Let us know what you think about this whole AMD situation. We really want to hear from you. We hope to see you again in our next stock analysis.
Goodbye, everyone.
Goodbye.